Hey everybody, it's John. Today we're going to be looking at SPX over gold. This is part 2 of my intoxication thesis video. So today we're going to be looking at SPX over gold. First off, I want to explain what SPX is. Basically, this is the S&P 500, and what the S&P 500 is pretty much the all-star team of the stock market. It's the top 500 stocks or companies all valued together in one index to kind of give a gauge of how the market is moving. So SPX over gold, the honest scorecard, measuring stocks against the ruler that doesn't change. So the question I want you to ask yourself is, has the stock market actually made you richer? Not richer in dollars. The dollar is just something that keeps getting shorter and shorter based on the money that we print, inflation, because it's a fiat currency. It's not denominated in anything. It's basically floating in the air, something that really doesn't grow value or hold value anymore. So instead, I want you to ask yourself, are you richer in something real? Gold can't be printed. Supply is fixed unless you find more, but that's more of a, that's a small amount. So it's pretty much something that you can base your wealth upon, that is fixed throughout history. Throughout history, gold has been the number one thing that wealth is denominated in, that people strive after. And so I want you to look at that rather than looking at your dollar amount in your portfolio. So we're going to look at a house. We're going to give the idea of buying a house. When you buy your house, this house right here is $400,000. The house in gold would actually cost you 87 ounces of gold. So the SPX over gold means how many ounces of gold does it take to buy the S&P 500. Basically the entire concept that we're going to be talking about here. SPX over gold, we are going to look at it right now. This is it right here. Sorry about that. And as you can see, it goes up and down. This is the Great Depression, the run-up of the stock market in the roaring 20s. It goes up a lot, then it crashes. This is, I guess, prior to us going on the gold standard. 1971 here, and you can see this complete drop off. Rise up again, maybe during the stagflationary period. I don't really have an explanation for that. And then this is basically the big old tech boom, the dot-com bubble. And this right here is the real estate crisis, 08 recession. And then here's basically where we've been at for the past couple years. So SPX over gold, the slash just means divided by. The S&P 500 price divided by the gold price equals the ounces of gold to buy 1 unit of the S&P 500. When the ratio goes up, like here, it takes more gold to buy the entire S&P 500. So that means that stocks are winning. When the ratio goes down, like here, that means it takes less gold to buy the entire stock market or the S&P 500. So gold is winning, even if your statement on your portfolio looks good. So the honest scorecard, we're going to hone in on 2000, the dot-com bubble, this massive spike right here, versus today. So in the year 2000, it took 5.59 ounces of gold to buy the entire S&P 500. Today, it's 1.48 ounces of gold to buy the S&P 500. Basically, 74% less gold is needed to buy the S&P 500. However, in dollar terms, since this point in 2000, the S&P 500 went from 1,500 to 7,000, which looks incredible. But when you denominate it in gold, the S&P 500 lost 74% of its value since 2000. It never recovered from this massive point. I'm going to show what the S&P 500 looks like from that point. If it will load, it might not. I might have to do it on a new one. Let's see. Let's reload this. Bear with me. Got the Nikkei right there that I've been tracking. Alright, SPX. Alright. Also following the oil volatility index. So, alright. Around, where's 2000? Okay, so 2000 was at this point. It was around 1500. And now you can see this. Okay. We're going to go back. And okay, that's perfect. Okay, that's what we wanted actually. That worked out perfectly for us. Get rid of that, get rid of the volume, and then we'll go back to the all. Okay. The stock market in dollar terms is at all-time highs. We saw that brief dip, Liberation Day last year, I think April 2nd, the week of April 2nd, and then we saw the dip kind of in late March, early April from the Iran war. But since 2000, the stock market in real money terms, in gold, has never recovered its year 2000 peak. Both things are true at the same time. The fact that the stock market is at all-time highs in dollar terms, but it hasn't recovered in gold terms since the year 2000. It would need to more than triple from here just to get back to where it was in 2000 in honest money terms, and that is if you keep the gold price at where it is now. So I'm going to give you a scenario. The two friends, same $10,000, same year in 2000, two completely different outcomes. So friend A invests in the S&P 500. The initial investment of $10,000. The growth, grows from that point to now of $49,000 with reinvested dividends, or it's around $80,000. The return multiple is around 8 times. Friend B in the year 2000 invests $10,000 in gold. Gold price around that point was $270. Now it's around $4,700. Today it's at $4,569. So the value today is around $174,000. The return multiple for that 17.4 times. So gold outperformed the S&P 500 total return by over 2 times in 26 years with 0 dividends. Just the plain and simple what you bought in the year 2000 to now. Friend A did not beat friend B. Friend A got absolutely destroyed. He just didn't know it because his statement is printed in the same dollars that keep getting weaker every year. The stock market is supposed to be the smart money, the professional money, and it lost to a rock sitting in a vault for 26 years straight. That is what SPX divided by gold is showing you, the honest scoreboard. Now we're going to move into SPX over DXY, stripping out the dollar. It's a different version of the same question, and why SPX divided by gold is still more honest. So this is the chart right here of SPX over the DXY. The DXY is basically a collection of currencies and the dollar kind of to show basically what the global reserve currency is looking like. Here we can see, here is 1971, it was around 0.5. The year 2000 it was around 14, and now it's sitting at around 72.35. Alright, so the dollar's report card, what is the DXY? The DXY measures how strong the dollar is compared to 6 other major currencies. The euro is around 58% of the index. The Japanese yen is around 14% of the index. The British pound is around 12% of the index. The Canadian dollar around 9%. The Swedish krona is around 4.2%, and the franc is around 3.6%. So when the DXY goes up, the dollar is stronger. When the DXY goes down, the dollar is weaker. So why is SPX over gold more honest? SPX over the DXY measures stocks versus other paper currencies. The problem with that is that no currency in the world right now is pegged to anything. It's just free floating. It's a fiat currency. So every single one of those currencies that we saw in this one are also being printed like the US dollar by their own central banks. You're measuring a shrinking ruler against other shrinking rulers. It's useful, but it's incomplete. SPX divided by gold measures stocks versus something nobody can print. Gold supply is fixed, nobody debases it, and is the only fixed ruler in the room. It's the most honest version of how the market is really doing in actual terms of value. So 2 people, both are getting shorter. Which one is taller? You can't get an honest answer by comparing 2 things that are both broken. The DXY compares the dollar to other currencies, but the euro, yen, and pound are also being printed. So the DXY understates the real problem. You should use both charts, and actually you can't see that Very sorry. We will move me over here. You can use both charts, but don't focus on one. You need both of them and trust gold more. Even adjusting for dollar weakness, the market is still parabolic. When we go back to this, and let's go to 2020. Alright, 2020 starts right there. So the lows of 2020 was around 21.56. Today it's sitting at around 72.35. The long-term 200 moving average sits around 31. That is this one right here. The teal, I believe. I kind of have a filter on my screen, that way my eyes, but I believe that's like bluish for y'all, and then that looks to be more yellow. It looks more orange for me. This is the 20, more of a shorter moving average. So it's 2 times its average. And post 2020, it's near vertical. If you go back, it doesn't look vertical on this, but when you scroll all the way back out, it's pretty much vertical, which is not a very healthy thing. 2020 is right here at that point, the start. And I mean, it just completely goes up. So not a healthy indication of a market at all. So this isn't just a dollar problem, it's a global liquidity problem, and gold already knew that. So the honest scoreboard, the summary, the SPX in dollars is at all-time highs. It's what everybody sees. It's what the news loves running. Hey, we're at all-time highs. It's what Pam Bondi, well, she was talking about the Dow Jones, but she was talking about, well, the Dow's at 50,000. Why should we care about Epstein? Well, is it really, good that it's at 50,000 when it's denominated in a currency that's faltering and deteriorating? When you compare it to gold, it's down 74% since 2000. It's, when you compare it to the DXY, it's 2 times above its long-term average. So gold wins 17.4 times versus an 8 times return since 2000. The merchants wept because they thought that the machine would never stop running. So I will leave you with this. This right here is before Roosevelt revalued gold. This right here is Nixon. This right here, pardon me, is 2020, around here. It was at 1,400, and here's today. It's sitting around $4,500. So this is kind of where we're at now, and I hope this was kind of more of an explanation on my previous video. If you want to see a more in-depth look, go check out that video, and I hope you enjoyed. Thank you.